you so much, Marty. I met Marty about 5 years ago, and I think this is about my 12th panel that I'm now moderating. I plan to have it that we're going to have a lot of fun in the next hour or so. After the drone, I was walking downtown Los Altos a few weeks ago, and there's ASCA, there's the flying car. So I guess it would have been better if they had that already in and not a prototype. I could have just flown in my car here, which would have made it a little bit more dramatic experience. So I've been on the board of directors of CAI International for the past 14 years. It's a company that operates in the global transportation leasing space, and it probably is a good introduction to alternative credit because it's both highly leveraged and highly cyclical. So, and plus I've had several other experiences in restructurings where you've had to go looking for money. So we're going to dive, but before we dive into that, the first thing and how we're planning it is we'll go and let everybody give a brief introduction. Marty's talking about 3 minutes or so a piece, and then we'll go into sort of I'll set the stage for the macro, and then where alternative lenders play, and then I'd like everybody to elaborate on that. Then afterwards, you can do more of a deep dive into your particular companies. So the way I'm going to take it is I'm going to take it in the order of the people on my screen, left to right. So that's the way we'll do it. You know, I don't know if Marty subscribes to the Geneva Convention, but this is going to be a little longer than name, rank, and serial number, but try and keep it to 3 minutes because each of us is going to have lots of time here to speak. So I'm going to first call on Lance. Lance was gracious enough to arrange the pre-meeting before this. So Lance, take it away and tell us about your business.
Good morning. My name is Lance Holman. I'm president of Holman Capital Corporation. I've been in banking now for about 28 years. I spent 16 years at JP Morgan, US Bank, and SunTrust, both on the trading floor and in public finance. My last 9 years at SunTrust, we've primarily focused on equipment financing, which is what all the large banks do when we finance large governments. And I had presented an idea to our bank that we should create a new business unit and make me the president to focus on small and medium-sized governments, but not only finance their equipment, but their infrastructure, their facilities, their energy needs as well. The bank said no. I resigned. I had $500,000 in my pocket, and I started Holman Capital in December 2009. And today, we finance governments, educational institutions, and water systems throughout the United States, primarily in the West Coast. Transaction sizes are as small as $250,000 up to $100 million. Most of our deals are between $1 and $30 million. Our investors are all community banks. We picked community banks because they were very sophisticated. They already had the portfolio operations set up. They were local, and they did not have a public finance shop. So if you can imagine them outsourcing to a public finance shop, that's exactly what we do. We originate the deal, we underwrite it, we price it, we document it, and then we co-invest or assign our interests over to that community bank. And we stay with that relationship for the life of the loan. So when the client wants to do future transactions, we are there to help them and partner with that community bank or multiple community banks if it's a larger transaction. Look forward to chatting with you. Thank you.
That's a great summary. Lance, you're probably in the IvyFON Hall of Fame for a great summary. Tim, you're next.
Hey, Tim Barnes. I appreciate you guys having me. I run my own firm, Axis Group Ventures, which is a credit markets advisory firm. I have a background as a venture lender. I spent over a decade at Silicon Valley Bank and Hercules Capital. I'm kind of unique in the fact that I do advisory work, but intersect a variety of credit products. I'll intersect private credit funds, BDCs, banks, and family offices. And so bring a unique perspective to the panel and interested in the conversation.
Boy, we went fast. Now I see Scott on my screen is next. So Scott, take it away.
Hello, everybody. Scott Griest, first time being on a panel here for IvyFON. Basically a classic fintech entrepreneur. who seeks to really find above market returns in specialty niche products. Originally, I had a merchant cash advance company. Many of you may have heard of that before, a small business lender. Put out $2 billion from 2006 to 2019 before selling that to North American Bank Card, the fourth largest credit card processor in the US, and was really able to leverage alternative data on the macro and the micro level by the user level to drive down bad debt in that market space. Currently, new venture is Prima Health Credit. We finance ortho, dental, LASIK treatments through the originated through the doctor offices, and just completing our Series A right now. We are on a run rate to do 100 million originations this year. And we really focus also on layering other data to focus in on the underbanked and the subprime marketplace and score much more than just FICO to really control bad debt and drive yield. Pleasure to be here.
Okay, so I've got to shift my screen a bit here. Who's next? We got, I guess we got Zach. So Zach, take it away.
Thanks, Gary. So I'm a venture lender, but I came from 15 years in the public markets and was an investment banker, portfolio manager, and trader at places like Scotiabank and Deutsche Bank and Sun Life. So probably executed roughly 50 billion in debt transactions in my life and saw a huge opportunity in venture debt. Venture debt is really simple. It confuses people because they just don't really know about it because it's relatively new. Think of it as term loans plus equity warrants to really fast growing companies that are typically Series B through Series D with revenue of 10 million to 100 million plus. Loans are typically, at least in our strategy, we tend to be a little bit bigger than most, anywhere from like 10 to $50 million loans with the equity warrants attached. These are pretty short duration loans. They're senior secured for the most part, often with the first lien, sometimes with the second lien, but typically first lien debt. So historically, the strategy has produced phenomenal risk-adjusted returns, actually better, in fact, than venture equity, private equity, real estate, public bonds, public stocks. To just give you some hard numbers, returns have averaged over 20% per year at the fund level. Banks, obviously, much lower returns. We don't really compete with them. So think of it as 20% return historically, with loss rates less than 50 basis points a year and very steady returns, very low correlation to the market, very low volatility. So you're basically looking at a strategy that produces a lot of income. Most of it's contractual, but you also have unlimited equity upside via the warrants. So this is a sector of the market that really was not known by most, I would think, 2 years ago, but now it's very popular, probably one of the most popular segments of the market. I'm actually down in Texas right now. I live in LA and run the fund out of LA, but I'm in Texas speaking at one of the biggest pension conferences in the country next week in Austin at TechSpurs because all the pensions want to know about it. I mean, and you can't get access to this strategy very easily. Essentially, there's a couple BDCs that do it that are publicly traded. Tim Barnes used to work for one of them, Hercules, and there's some banks that do it that don't really compete in our segment of the market. So essentially, you've got a bunch of closed-end funds that are pretty small. They're usually sub 500 million, and they're always oversubscribed. So if you like the strategy, there's almost no way in. So it's actually great because we're raising $500 million right now, and the demand's been quite strong. So I wanted to make sure that the family offices got to look at it, because if you don't get it now, you're probably not going to get in because everybody's always re-upping based on everything I've seen. There's only 2 or 3 funds in the country that are offering capacity right now. So that's it for me. Thank you.
Okay, great. Now I see next on my screen is Jan.
Hi, Gary. Thank you so much. And Marty, thanks for inviting me as well. Our business is lending on real estate. So we lend up to $10 million per transaction. We started our first fund in 2010. We've done just under 2,000 loans since then. And this is really a space that was created because after the financial crisis, banks are pretty much discouraged from lending to real estate investors and developers. So non-bank lenders have stepped in. There's a lot of institutional capital that is going after the space of 10 to $100 million loans, but under 10 million, it's been less competitive. So, we enjoy 75% of our loans are to repeat borrowers, for example. We mainly lend on residential properties, not owner-occupied homes. We make loans to investors and developers. And we're based in Los Angeles, and we lend on the West Coast. And I'm looking forward to the conversation today.
Okay, so that looks good. We got through. Did I miss anybody here? I've got a couple people on the screen that are Bill, sorry, you just came in there. Okay.
No problem. Hi, everyone. My name is Bill Bymel. I'm also in Los Angeles this morning. I am the founder of First Lien Capital. We are investors in seasoned, non-performing, sub-performing first lien mortgages, primarily residential real estate, with a focus on the future, also in small balance commercial. I've got 20 years of real estate experience. I own two real estate brokerages in Florida, where I just moved from last year. One commercial, one residential. I've been an investor in commercial and residential real estate for almost 2 decades now. I've just exited a senior level position at Spurs Capital, a New York-based investment manager in this space, where I've been for 10 years. I built a team, then managed several funds there. We've placed close to $1 billion of equity in this space over the last 10 years, averaging about $100 million a year of investments in discounted first lien debt that we can buy at a discount. And then I remain a signatory and advisor to those funds at Spurs, but I left last year to found First Lien Capital in preparation for some of the exciting opportunities we see in the days ahead. Look forward to more discussions.
Well, we got through that really good, and so it sounds like it's going to be an interesting day. I'm going to set the stage on the global markets here, and then ask people to drill down. So, down the street from the hotel is Chef Chu's, probably one of the best Chinese restaurants around. And on Valentine's Day, I showed up there with my crimson HBS jacket. Larry Chu Jr. came out, and the first thing he said to me is, what they don't teach you at Harvard Business School, how to run a Chinese market restaurant during a pandemic. And isn't that the truth? That guy instantly saw the situation. He got his waiters in yellow vests, and he started taking takeout. Sometimes he has 20 deep in terms of backup, in terms of cars picking up at both lunch and dinner. And I think that's where, especially during the pandemic, we needed to think fast and understand the global implications of it. So I called up Harvard Business School Research Department and found out that they have never taught a course on how to participate and react to a pandemic. But what I found is that companies such as my own in CAI that are highly leveraged and highly cyclical and actually have assets to finance usually perform best. So, there's an old theory on Nob Hill. The ladies say you can't be too rich or too thin. And in terms of being too rich, the best thing to do is have some lines of credit available in bad times. And one of the reasons you didn't see too many bankruptcies is there were $600 billion of lines of credit, 600 billion. And the banks could easily fund them because they had 5 times that amount in liquid assets, either in money market funds or checking deposits or so on. And so those people that had access to money really were in good shape. They had established lenders that they work with. They had some assets or collateral that they could finance, and they were able to quickly see what the implications would be with the disruption of the supply chain. But then we have everybody else, and a lot of these guys, if you look at a restaurant, if a restaurant's closed down and can't figure out how to do takeout or whatever, what the heck's he got there? He's got a bunch of food that's going to spoil. He's got restaurant equipment. There's probably tons of it available. And he's sitting there, just sort of wringing his hands. So In terms of alternative credits, it's a good deal. Coaching is really good. And so I think in terms of all of this, you've really got to go ahead and take a look at what your sources are, before it sort of starts to rain. So I think that each of us can sort of tell the story of their niche market and how they got into it, and really how they participated both in this pandemic and also in times where people just don't prepare for a rainy day kind of thing. And I think since Tim's the first guy on my screen there, I think I'm going to have him elaborate on his business.
Yeah, so just maybe I'll just comment observations in market with that intro on the topic. I mean, for me particularly, working with a lot of innovative businesses in market, the PPP funding the last year was definitely instrumental for helping a lot of businesses manage around the pandemic. A lot of the engagements I had with businesses, people were successful, firms were successful raising PPP. That in some ways kept companies afloat during the pandemic, gave a lot of runway. For a lot of lenders, it was a competitive product. I'm sure some lenders lost some deals because PPP funding, gave companies liquidity. So I think that was key. But then on the lending side, I mean, I think you're right. The market's dynamic. When there's a pandemic, a lot of companies would ask for credit, dry powder through term loans or lines of credit, and those that had liquidity, those that had capital were able to find opportunities in market.
So Scott, you provide a very valuable service here to people really on the perhaps the lower end of the income spectrum in terms of medical and dental financing. So those are a case where I suppose you're always going to have people that have an emergency and don't have any funding for that. So that's a business that probably serves it well, but you know the demographics of these people really well, down to between cosmetic surgery and dental work. So how did you decide to go into this business? Because it's a business that does provide to some real needs that people want to get.
Yeah, we saw it as a niche that to leverage alternative data, because the big players in the space, Care Credit, Chase Health Finance, Green Sky, they all want to finance the prime and super prime. So if you're in pain and go to the dentist, they're going to say yes only 4 out of 10 times. So we saw a really great opportunity to come in and pick up that subprime client and drive a lot of yield off of it. Our business model works that if someone comes in for a $2,000 crown, we give the dentist maybe $1,800 to $1,700, and then we charge a risk-adjusted interest rate to the consumer as well. So we can drive a lot of yield there. And then what we saw in the pandemic is just because there's a pandemic doesn't mean you don't get a cavity or you knock out a couple teeth. You got to get work done, no matter what it would be. So we saw our business boom in this time, and we saw our doctor offices that drive the loan origination scrambling to help finance these patients, because they were paid for the marketing for these patients to come through the door. They paid the staff there, they paid the overhead. So they just had to leverage and create revenue off of it. Now, when we look at the data of how we do it, we barely use FICO. We pull a lot of other different data sources, like we'll pull payday lending data sources. We'll pull utility and cell phone payment data when analyzing these clients. Then we look at a lot of macro data as well. There's so many good databases to go into, such as with people with no FICO, we use a product called Plaid, where they give us access to their banking data, actually. And you can log in and scrape 90 days worth of banking data, and then it really drives great lending decisions off of that. So that's some of the ways we use it and leverage it.
So I'm going to do a follow-up question only on this one, because these are pretty small scale people in terms of dollar amounts. I think you tell me the highest amount you have, but to really look at these on you've got to have a mechanized process because you can only make so much money on these guys.
Yeah,
So,
completely automated. Our average size is $3,000 is the average
yeah,
transaction size.
so how do you set yourself up for the kind of volume, and how much time does it spend to kind of to get a guy credit approved?
Well, it takes us about 5 to 10 seconds because we really leverage APIs pulling to all these different databases. And one of the things we can do, which is really interesting, is through our application process, we ask them to give us access to phone on their data. We can use the data on their phone to make a lot of good decisions. One of the things I shared with the group preparing is we found out that if someone has the first and last names of their contacts in their phone capitalized more than 80% of the time, they're 4 times less likely to default. Now, I can't tell you why they're less likely to default. I can guess, but all I know is the data as we're driving sure is a damn good indicator whether someone's going to default or not. We can use all these different individual things. Another thing we look at, we can tap into a database that tells us how many tax returns are filed per household by individual address. If someone's got 3 or 4 income taxes returned, we discount down what their housing cost is in our DTI calculation. So whether not only to drive a yes or no decision, but how much credit should we give that person? Should we give them $1,000 or should we give them $5,000? So we're really dialing these alternative markets to drive down bad debt and just basically generate greater yield. So a lot of cool things out there in this marketplace that you can do. I'm sure a lot of the other panelists see the same types of things in their niches.
Okay, so that sounds great. I'd like to follow up that with Lance, because there, during the 2008, kind of collapse of Lehman, municipalities kind of ran out of cash. Of course, they kept padding the pensions of their employees, but you'd have these shovel-ready projects where a guy would be fixing a pothole and a sidewalk or something. And I went in there and to the town council, not exactly most popular guy, and I says, if you guys don't have money reserved for that, what the hell you guys been doing? You're supposed to be councilman. You're supposed to be trying to get things prepared there. But in terms of a municipality, I would think, Lance, that you've got so many things that you can secure. There's revenue streams from property tax, maybe water, sewer, or whatever, so that in terms of collateral, you have the collateral to make a loan if you want that, and even pull money out of things that have already been paid off, that you can, fully paid assets that you can recollateralize. So in that sense, it would seem like you can have a much easier time of doing that.
You're right. But at a 30,000 foot level, we are financing monopolies at the end of the day. When you think about the federal government is the bank and it's the rule maker for society. The state governments are like regional managers, and the local governments are implementers and first responders. So the federal government can't get anything done without a regional manager and an implementer. So even if that municipality ran out of money, that municipality is going to have a bank that backs them to implement federal policy. But also that local government has its own tax base, and some tax bases are better than others, and some are much more proactive than others, and others will pass tax increases, or they will bring in new management teams to run the government more efficiently. So at a 30,000 foot level, they're not all the same. They're very different. Newport Beach is a lot different than a lower income city, for example. But in terms of collateral, in terms of securing your capital, there's 2 broad categories. A, you can secure it with the fixed asset. So the police station, the fire truck, the airplane, or you can take a revenue stream. So if you had an airport, for example, or you had a water agency, you don't really want an airport or water agency's pipes to be your collateral. What you want is the airport fund or the water fund, and everybody uses that natural monopoly and sends capital to that fund. And so we secure those transactions with either the collateral or the revenue stream. What was unique about our business was that the municipalities at the lower end, the small and medium-sized governments, tend to hire people that may not be as financially savvy. So if you can pair both advisory services and capital and package it for that client and show them the same ideas that the city of San Francisco or the city of Los Angeles that has Goldman Sachs calling on them, if you can bring that to small town America, then you can get market share. And how do you reach all 130,000 municipalities? It's exactly what we're doing right now. We reach them virtually. We build content on our website. We have videos, we write white papers, and we disseminate, and we build massive databases of the decision makers of America's small and medium-sized governments. And that's how we do it.
So that brings me to another question. I'm sitting here and reading the local newspaper, and one of the municipalities, I believe it was San Carlos, someone, maybe it was a Goldman Sachs guy, presented a deal and says, you know, you want to borrow $40 million, but you know, you don't have the funds to really pay it back right now. We can get you a zero coupon bond, so you don't have to pay anything for 20 years or whatever the term was. So, and so finally a newspaper picked up that story and says, you know, these guys thought they were pretty smart, but they're going to owe like, you know, $400 million in 40 years. So that's a problem. And they asked one of the councilmen, he said, well, 40 years from now, I'm not going to be on the council. At least I don't think so. So there's got to be a lot of guys, there's got to be marketing of products like the zero coupons that, you know, people will buy, investors will buy, and yet they don't seem to make sense. And I'm looking at Argentina. How many times is Argentina? They issue 100-year bonds in Argentina. They've defaulted, you know, 4 or 5 times in their history. So I guess there's a market for them, even if you just pay a little bit more. But what do you do with municipalities that just don't seem to have any credit sense or control over their finances? Are they just lost causes and you let them go their separate way?
I tend to start with knowledge, and I try to educate people and give them alternative ways of looking at it. One of the biggest problems in our government is that nobody owns the government. No one owns the fire station. No one owns the airplane. So quite frankly, you don't care about it as much. But if you educate that borrower and they don't want to be perceived as being less than intelligent, they tend to make the right decision. When I was at the large banks, it was more price sensitive and we were expected to get the deal done. And we at Holman Capital did a pivot. We said, we're going to approach it and help you make a better long-term decision, not only for you, but for your grandkids. And if we all do that and we bring ideas and capital to our governments and deploy those resources to make the world a better place, then we all benefit from that. So that is our kind of high-end altruistic approach. But quite frankly, not many people are doing it, and it's incredibly profitable.
So I'm going to go on to Bill. You know, you take non-performing loans. How about a non-performing muni loan? You know, are you game for that or what?
Sure. I mean, you know, those tend to be larger loans, obviously, and they don't necessarily trade at a discount. So it's not necessarily a game that we've been playing in. We're buying average $300,000 residential loan sizes, and on the commercial size, we'd be an average of a $2 million loan balance. The other thing that comes into play with buying municipal loans is similar, that are in distress, similar to buying like a church loan, is the PR risk involved in that. We've built our reputation around being very borrower friendly and looking for alternative ways to service our non-performing debt, you know, in as almost like partners with our borrowers, whether it's you know, the first 30% of our portfolio that we modify and keep people in homes, or finding ways to discount the debt so that you know, we can exit sooner, or incentivize the borrower to make a resolution. When it comes to things like municipalities and churches, you run into a lot more sensitivity on a public level. And so we tend to stay away from that kind of thing. We try to stay out of the public image in that regard. What about you, Jan? I have to
Yeah,
throw it
Jen,
to the
that's
other
a
lenders.
good entree into his,
Yep.
because I looked at, I met the guy who does Dr. Housing Bubble. I don't know if you ever remember that guy on that blog. I met him at some event, and he's a fascinating guy. One of the things he said, that during the subprime era, in what, 2006 and 7 and 8, 20% of all the subprime lenders never made a single payment on their house, but they were homeowners, and so
Right.
it was their home, and many times they pulled more money out of it than they actually put in. So that's kind of the non-performing. So I think in both of you, because you're lenders, what happens? You know, you've got to have some con men in there, or some people that aren't going to pay under any circumstances. So
Very good question. Jan, you want to start with this? Because I have some real serious thoughts on the matter, and it's your business that I, you know, line the special business purpose loans, I think, is where some of that comes into play. You want to start?
Yeah, I'll take a crack at it. So it's our job to weed out the con men, and the way that we do it is going and seeing the property in person, and meeting the borrower in person, and seeing their past projects, making sure that they really know how to add value to properties. So we do a senior loan, 75% of cost typically. It ends up being 60 to 65% of value. That's because we lend on projects that are value added, where the developer or investor is experienced at creating value. So we do construction draws. We inspect every time we do a construction draw. So a great way to see if there's a problem is if nothing's happening at the property and they're not drawing out the construction funds, then we probably need to pay more attention to that. We've been fortunate, even through COVID, that we've only had about 1% of all of our loans have gone into default. So out of 1,800 loans, we've had about
Wow.
18 hard defaults. And I should say, you know, what I mean default, 30 or 60 days late, we've certainly had more than that. But actual foreclosures, about 1%. And then we've been able to make money on 3/4 of those. So I like to look at our strategy as a fixed income alternative. It's much higher yielding than similar bonds would be. It's got a little less liquidity than owning a bond, because you can't redeem immediately, but these are evergreen funds and you can redeem fairly quickly under the vast majority of circumstances. And then we use leverage in one of our funds to get a little bit higher return. And the other one is simple, no leverage, just to kind of generate monthly distributions. So,
Right.
but Bill, why don't you take it from here?
I'm glad to. First of all, I just want to point out that you're one of the good operators in this space. I mean, a 1% default rate on business purpose loans, which is the new way of saying hard money loans, right? Is a fantastic rate. I have a lot of friends that are competitors, you know, that are in your space, and some of them sit at some of these larger originators that are doing 100 million a month, and they're just waving product through. I mean, everybody and their mother who watches a fix and flip show on TV believes that they can be a real estate investor these days. And in many ways, the business purpose loans in that market has driven into kind of an Alt-A kind of category right now. I mean, I know 10% default rates on business purpose loans are very common, you know, on average. And we're seeing, I see only the stuff that goes bad. So, and I also speak to the guys inside of there. So there is a lot of fraud popping up. There's a lot of unsophisticated buyers. And unlike Jan, who's doing a good LTV where the borrower's got equity, he's meeting the borrower in person, some of these guys are doing 80% loan to value, or, you know, it's a 90% loan to cost, and they're financing 100% of the construction costs. I mean, I see how some of these loans are going bad because I've been able to buy a lot of them in the last year, specifically right after COVID started, when a lot of lines got shut down and we were really able to have a field day. But even in recent months, I've got some of the bigger holders of that paper coming to us with non-performing stuff. They can't understand why we're bidding below par. And so I think there's chickens that have to come home to roost in that market. There's a lot of potential for fraud. There's a lot of unspoken nonsense going on in that market, and it's something that everyone needs to keep an eye on.
So I'm gonna bring Zach into the conversation because you know, I had a roommate at USC, and he started an accounting business. He got a CPA. His wife had a CPA. Started in San Marino, California. Somehow he got guys that did Kentucky Fried Chicken franchises, which actually you make a lot of money in that thing if you don't if your managers don't give away too much chicken. You get the least popular guy in high school because you don't want the most popular guy who gives away an extra piece of chicken or two. But he decided to go into recycling of computer screens and others where you bust it all up and you get paid a certain amount. So he actually had a fund, and I would go down and see my my roommate there, you know, every year or two. And so this guy was booming, his business was booming. He was selling all his shares to friends and family, and then he wanted to go out to the angel market. And so for some reason, I didn't keep track of him for a while. All of a sudden, I get a call from him, and he says, you know, there's a problem. Turns out that this guy had a whole bunch of watered down stock. He sold like 10 times as much stock as he had on his cap table. So, you know, this was a sad case. Plus, he spent it all or whatever on a private plane or whatever he did with it. So you've got to have a few guys in the early stages that, you know, probably have some problems. Do you have any stories on that, or how do you weed those guys out?
Yeah, so Gary, I think so. One of the things you just touched on there is one of the big misconceptions about venture debt. So you kind of set the stage for me perfectly. We don't lend to early stage companies. This is not two guys on a laptop and a dog in a WeWork, right? We are lending to companies that have already done 4 to 6 rounds of institutional financing. So they've already done a Series A, they've already done a Series B. Before that, of course, they did an angel round and a pre-seed and a seed round. So we're coming to them when they're basically looking for growth capital. They're already on an incredible trajectory. They're kicking butt. They've got some of the best VCs in the world backing them, who've been backing them for 5 to 10 years. And they just want cheaper, less dilutive capital. So there's this big misconception, huge misconception, because people hear the word venture and they think really early stage, really risky. In fact, it's the complete opposite. We're lending to funds or to companies, excuse me, that have really hit that peak convexity point in their growth, and they're just looking to raise more capital so they can grow more quickly. So they've already been de-risked, and that's why historically the loss rates, and you should write this down, less than 25 basis points per year over the last 20 years. It's lower than investment grade credit. And Hercules, Tim Barnes' old shop, has lost less than 5 basis points per year. Silicon Valley Bank, who underwrites everything under the sun, basically, isn't an investor, just a commercial bank. They've got loss rates less than 25 basis points for the last decade, right? So this is an incredible strategy. It's about 10 to 15% of the total venture market every year, and it's growing. Why is it growing? Because the market's becoming more mature, more sophisticated, and people realize, wow, that's a great alternative. I don't need to sell 20% of my company every round to some guys that are providing capital where there's an opportunity cost of 0, right? So they finally come to their senses, and now everybody's saying, wow, if I've got a great company, why would I give it up after I've built it? I don't want to own 3% when it IPOs. I'd like to own 15 or 20 or 30%. Right. So that's what we do. We provide capital to founders that have already hit a home run, and they're just trying to keep more of their company. They don't need the capital, but they're using it for growth, right? So we're not providing capital to people that need it, that are about to go out of business. No, quite the opposite. We're lending. Our LTV is typically 20%, and our collateral is cash. And so people say, well, startups, what do they have as collateral? Straight cash, homie. like much better than anything you're going to try to sell that's a hard asset that's going to take 2 years to get a bid on, right? So that's why this has been so successful. You lend against cash. You've got the implicit sponsorship of the best VCs in the world. You're lending to companies that are growing 50 to 100% every single year, year over year. These are all tech-enabled companies. And if you look at what happened during COVID, which companies are driving growth? Innovation-oriented companies, tech-enabled companies, right? So what we're really doing here in a nutshell, providing access to innovation as an asset class, right? Except we're playing it from the debt side. So instead of having all the equity risk and all the valuation risk, you're sitting senior secure with a first lien. If things go wrong, you take the keys of the company. And you've got 5 times as much cash on their balance sheet than you have outstanding in the loan. So, I mean, I appreciate that question, but it's just not at all.
No, that's right. That's great. And because you do see a lot of people on the circuit, although it's a virtual circuit now, who are looking for a bridge loan, and it's a bridge to nowhere. And not only because you don't have they probably can't get to that milestone, but also they've, half of their money that they're going to raise is going to go pay guys that they haven't paid before. And they're so happy to say, hey, I got invested with, Wilson Sonsini's making an equity investment. That's only basically writing down their, part of their legal fees. So yeah, you don't have that. Well, there's another question. Marty I actually saw this one on the screen, talked about warrants. Is there a place and we'll let you start off, Zach, but then the others can chip in. Is there a place for warrants, in your portfolio, and does it make sense to kind of tune the rate or stepped up interest rates or something, some participation, and under what circumstances do you use those? So
in venture debt, typically all the deals, or the majority of deals certainly, have equity warrants attached. That can typically be 5 to 20% of the notional amount of the debt. So what's great about this strategy is you're typically looking at some upfront fees, cash interest of 12 to 15% per year, depends on the stage of the company. It can be a little bit lower as well, so call it 10 to 15%. And then you get back-end fees. So on average, the back-end fee at some of the bigger BDCs is 6 points. And the loans are 2 years outstanding on average. So it's annualized, it's 3% per year. So essentially you're looking at 15% cash return every year. Over the last decade, the debt yield from the 3 largest publicly traded BDCs who have all their data available on the SEC's website has been over 15%. The warrants are typically worth 5% plus annualized. It really depends on what stage you're investing in and how smart you are, and how lucky you are to some degree. And what's great about the strategy is that the warrants, in theory, actually in practice, they more than offset any losses on the loan. So there's a lot of opportunity here on the upside as well. So that's one of the reasons why investors really like it, because it's a very low volatility strategy, very low correlation to other asset classes. It's kicking off 3 to 4% cash every quarter, right, with very low vol. And then you've got these warrants that could be worth an infinite amount, essentially. It depends if you get a little bit lucky. If you've got warrants in like Uber, then this kind of strategy could return 100% in a year. On the downside, if you don't get lucky, you're still looking at 12 to 15% return. I mean, it's a phenomenal return distribution. And all the data is there to back it up. I'm not just making this up and saying, hey, maybe in theory we could do this. I mean, it's all available on the SEC's website. Type in edgar.com. Go to the 10Ks of the BDCs. They list every deal they've done since they've been public, with all the data on the spread to benchmark, back end fees, PIK interest, warrant coverage. We've done all the work. I know every deal that's been done in the last 15 years, and then returns are incredible. So all I have to do now is just educate people that are willing to listen and learn. So how about your salesman? How do you compensate your salesman? I had a friend years and years ago who actually got a warrant that paid off something like 100 times. He goes to the CEO, and the CEO says, if I paid you per the terms of your contract, you'd be making, a multiple of what I make in a whole year. So I'm not going to pay you that. So do you have, the sales, the people that get the deals? There's a structure there? Gary, everyone's different. Everyone runs different models. The way we do it is a cradle to grave approach. We want the originators to own that risk through the entire life cycle of the loan. Otherwise, the incentives are misaligned. Then you have originators just trying to push deals through, trying to hit a home run, get their warrant, piece. So we with our fund, we're a 5-year closed-end fund with a 3-year investment period. Everyone that works here that's on the investment team is incentivized with a piece of the carried interest. But we have a European waterfall structure with a 6% preferred return. So we don't get paid until our LPs have gotten paid. And nobody gets paid unless the fund does well. So there could be somebody who brings in the best deal of all time. They're going to get paid whatever their percentage of carry is. And I think that's the way you align incentives to really grow the entire pool for everybody and align with the LPs most effectively.
Yeah. So, okay. Well, that's good. You've hit it. How about in real estate? Both Bill and Jan, what would you say on terms of if you get a kicker? I guess you could get that be a participant in a future project if you're lending there, but non-performing loan, I don't know. What do you do? Get a kicker in terms of the next time the guy's in, hit bad times, or what do you do in those cases?
Jen, you want to start or you want me to start?
Why don't you start?
Yeah, obviously I'm not getting kicked. So I'm buying my loans from other investors, banks, or competitors in the space, but I'm also paying a discount to face value. So the kicker is on the buy side, right? What I will say is for my investors, and we have a similar structure to Zach where we don't get paid until our investors make money. All of my personal investments sit there at the same LP structure as every one of my partners in my platform. And we give right of first refusal to our investors on all new projects. Obviously, we've raised 10 million into what we will max out as a $50 million equity piece this year. And then we have joint venture and bank facilities that will go up to 90% advance against that. So we could be building this up to about a $500 million fund in the next 2.5 years. But there's obviously no warrants. I'm buying first lien debt. I'm buying it at a discount. I just bought 19 loans of 13.5 million of debt on 15 million of real estate, and I paid under $7 million for it. I do have personal guarantees from most of the loans with the borrowers, but we usually use that as a carrot to help negotiate out of a troubled situation. Jan?
Yeah, so we do not get kickers. We're occupying the same role as a bank, senior lender at 75% of cost. We're distributing a net 7 roughly on our unlevered fund and about a 9 on our levered fund with 1 turn of bank leverage. And the kickers in real estate don't really start anywhere near where we are in the capital stack, right? That would be more preferred equity or mezzanine debt. And we really aren't active in that area. We're just taking advantage of the fact that these borrowers want to move fast. They don't want to deal with the brain damage of a bank lender and all the rounds and rounds of questions and uncertainty about whether the deal is really approved, because oftentimes there's layers of approval that are needed before the borrower really knows that they can get the financing. So we just are charging, in the 7.5% to 8.25% interest rate range, passing through most of that interest to our investors. No kickers. The only kickers we've gotten are on the foreclosures where we got a windfall profit, and we're not trying to solve for that at all. We're trying to avoid that. But we'll take it now and then if we need to. We just, next time, Bill, I'll probably call you if I've got one and see if you want to take it off my hands.
For sure,
But,
absolutely.
It's good to meet you.
Yeah. So Lance, I'm not sure what kind of kicker you get unless you own a city park now, or maybe one of these pensioners off the city unloads, is now, going to have to be living in your house. I'm not sure there's anything like that they can give you, can they?
No, it's not legally permissible. You can't have title to the asset. If it's real property, you can have a leasehold interest in the asset. So you have a time of use of the asset, and the time of use should be, we typically structure the deal 10 years longer than the financing. So if we finance a fire station, and if it happened to default, then we can remove the people out of the fire station and go technically lease it out to someone else plus an additional 10 years. So but at the end of the day, our default rate is 0%. Now we're talking about returns, we tend to play in the 10 to 20 year fixed range, or we will play in a 10-year reset range. And our yields are somewhere on a pre-tax basis, I would say 3.5 to 5.5, depending on the term of the financing. So if the client is looking, if the investor, which are primarily, my clients are all banks, community banks, if they're looking for what I call predictable income, and they don't want to buy treasuries, but they basically want to buy a derivative of the federal government, then they would buy a municipal bond. But if they wanted to earn even more yield on the same credit, they would purchase a municipal loan. Lastly, you asked about how we compensate people. Essentially, every loan that we do, we have a prepayment penalty on the loan. So let's say that the prepayment penalty on the loan is 104 for the life of the loan. And let's say that my fee is 3%. And so basically, as the loan amortizes down, you've got a 4% prepayment penalty on the outstanding principal balance. So therefore, the investor is always protected, plus a little bit of a cushion. As far as my employees are concerned and their ability to be hungry to go look for deals, we deal in larger size loans. And so there's that opportunity to do very well in that space. You can do very well if you are patient and you are attentive to detail.
Okay, I think the last speaker on this topic before we move on is Scott. I don't think you take any warrants on any of your dental work, but I assume you just, satisfied customers give you steady deal flow. Okay, I don't hear Scott there. Maybe he's repossessing some dentures there or something. Okay, so we've got about 5 minutes. Maybe we can each take turns and give a minute or so wrap up of what you'd like to say, what the questions we haven't answered. So I see, Bill, you're on the screen.
Sure.
What's your final thoughts?
Well, I think that I'm coming into a very interesting time. I've done this now for over a decade, primarily with institutional partners, that single institutional partners, to the tune of hundreds of millions of dollars in the last decade. And we are now, I consider COVID the slow moving black swan event. And especially in my world, where you have government intervention everywhere, in the terms of forbearance plans, and TDR and CECL reporting requirement changes, and I'll get into that in a second. There is, we're kind of in a wait and see mode. But the reality of it is, and I see the data every month, and we know there are at least 2.5 million residential mortgages that are in forbearance programs. We know at least 600,000 of them have not made a payment in over a year, and that's just residential government insured. I know a lot of private investors and banks that are portfolio loaning, that have portfolio loans that are not even reporting the forbearances or the defaults, because one of the little known things of the CARES Act is that there's two aspects of accounting practices were enacted after the last crash. One's called TDR, the other one's CECL. And they have to do with the bank's transparency when it comes to troubled debt. Those reporting requirements were stripped, and they are not enforced again until January of 2022. So we don't really know what's going on behind the scenes. I can tell you from what I hear and from the data that I see, it looks like there's a lot more troubled debt out there than anyone really realizes exists. And so that's kind of where I leave everyone with, is the fact that, the government's done a great job slowing the fall and softening the landing for millions and millions of Americans. But at some point, the free market economy will open up again, and we'll start to see some of the stress have to play out. It just has to play out through private markets, and that's where opportunity lies.
Okay, we're going to run out of time soon, but Bill, Tim, final thoughts?
Yeah, I would just say, my role, I primarily advise companies, growth companies on debt financings. And I'll just say in this market today, there are so many different flavors of debt financing available from different types of providers, whether it's venture debt, lower middle market, mezzanine, esoteric lending strategies to consumers or businesses. Yeah, it's quite fascinating. And so, and a lot of these different debt strategies have different yield targets, some current pay, some with warrants attached. And, putting myself in the shoes of a family office. If you're a family office looking at investments, there's a wide range, investing directly into funds. There's various fintech strategies that you mentioned earlier. It's quite unique. You see from the folks on the panel today, everyone's doing just a wide range of credit investing, which is fascinating. So I'll just leave it at that.
Okay, Zach, final thoughts?
Sure. So I spoke a decent amount about venture debt. So I won't talk too much more about it, but I did want to say that one of the things that's unique about our strategy is that we offer a lot of no-fee co-investment opportunities. So a lot of the family offices that we talk to, as well as institutions, really like that opportunity because they want to be able to cherry pick the deals that they scale up in and ultimately reduce their net fees by getting no fee co-invest. So that's something that that many people find appealing. So I just wanted to put that out there. If there's family offices listening to this that like to do direct investments and like to co-underwrite deals and like to see innovative deals that are proprietary that you're not going to see elsewhere, and like to see a lot of those deals, and like to make 15 to 20% return in senior secured loans with equity warrants, then reach out to me. I'm at Ellison@ARIVC.com, or you can check out our website at ARIVC.com. And I just wanted to thank IvyFON and Marty for having me on here and the panelists. I really enjoyed learning about your strategies. You guys are all doing very interesting things. And so good luck to you. I'm sure you'll do quite well.
Okay, final thoughts. Jan, you still here?
I am. I want to thank you as well, Marty and Gary. And I think one question a lot of people have is this a scalable market? Absolutely. Most real estate is non-institutional in size. If you fly over LA, what you see is a lot of non-institutional real estate, much of which is investor owned. So it's probably the biggest asset class of any of the asset classes we've talked about. And also, banks aren't coming anywhere near this market, I don't think, for the rest of my career. And I've got 11 years of track record in our original fund now, and my personal goal is to get to 30 years with consistent returns and low defaults. And banks are shrinking, they're getting bigger, and there's fewer of them. And so that tells you everything you need to know. And the regulation is not getting any easier on banks either. So this market's going to grow. We just hired a managing director up in Phoenix that I've known for 6 years. We hired someone in the Bay Area as well. And I think there's going to be companies like ours growing into different markets in the US, and we'll essentially become like a parallel banking system, but we move a lot faster. You pay extra for the speed and certainty of execution. But I think it's going to be a big market, and it's going to be a good place to invest as well. So thank you very much.
Okay, Lance, final thoughts?
I think the future in the public sector is private equity. I believe that the government should focus on the people. I think investors should focus on fixed assets. The idea that I believe is going to be most prominent is workforce housing, primarily for school teachers, where we go in and we acquire land or we lease land from the public agency, which is essentially surplus unused land, and we build workforce housing. And that workforce housing will be life cycle. You can have apartments for new employees. You can have single family dwelling for people in the middle part of their career, and you can have retirement. And essentially that person can stay on their campus for their entire life. And this will control the cost of labor for the school districts, and it will effectively put a control on property taxes. because in the United States. So that's another area that I think will be an area of focus. And then finally, if you can automate and centralize administrative services for public agencies, just in California, for example, there are 1,000 school districts. And so if you can imagine, you can automate those administrative services, you can create a lot of value for investors. And I want to also say thank you to the panel members, and thank you for Marty for arranging this. I was very impressed, and I've learned a lot. Thank you.
Okay, that's great, Lance. Final man is Scott. You still here, Scott?
I'm here.
Final thoughts.
Yeah, I think all these alternative markets are great. It's great to learn about everybody's strategy. There's so many ways to make yield that is non-correlated to the market. I think you really have to understand the niche that you're getting involved with, and also trust the players that you're entrusting your money to. I think overall, I think that's the most important thing. Do you understand the product and realize that there are just a ton of options you can earn a lot of yield from. You don't have to be stuck in that middle, low single digits. I think that's a big takeaway from this whole panel.
Okay, that's great. Okay, so we did all that. This is Gary Sawka. Before we sign off, we say, I think we had a lot of fun on this panel, covered a lot of topics. And if you thought that was fun, wait till tomorrow. Marty's drafted me for the FinTech panel here at 10:50 tomorrow. So don't miss that one. Marty.